Greetings to everyone. My name is Edward, and you can call me Ed. Here is pros and cons accountancy tutorials, and today our focus is on impairment. Impairment, which is IAS 36. So the question is, what do we mean by impairment? So when we say impairment is simply where your carrying amount is higher than your recoverable amount. Any indications which shows that your carrying amount is higher than your recoverable amount is impairment. Now the question is, what is our carrying amount and what is our recoverable amount? Carrying amount in simple terms or in a layman idea is how much you are keeping an asset in your books. It's how much you are keeping an asset in your financial statement. So if you have a vehicle and you keep it in your books or your financial statement as 10,000, that is the carrying amount. Then what is a recoverable amount, as I first mentioned? So the recoverable amount simply means how much you can get from the asset. If, let's say, you sell it today or use it to the end of its useful life, that is a recoverable amount. So let me go on it again. We said when we talk about impairment is where or a condition which will make your carrying amount higher as compared to your recoverable amount. So normally you'll be hearing impairment loss. It simply means that the carrying amount of a particular asset is higher than its recoverable amount. And the carrying amount in a layman idea is how much you are keeping the asset in your financial statement. To keep an asset in your financial statement, it simply means that you have the cost of the asset less what? Depreciation. So in this case, you have the cost of the asset. In simple terms, it's just your cost less depreciation. If it is an intangible asset, then it will be your cost less the amortization, right? The cost less amortization. Now, when we talk about the recoverable amount is first talking about either you are selling the asset today or you are using the asset to the end of its useful life. So surely we have the fair value less cost to sell, which is known as the net realizable amount, and also the value in use. I think the terms is becoming too much, so let's go to the board and understand some of these issues. So one, we talk about impairment, and we are saying that the focus of impairment is on one, the carrying amount. And then two, we talk about the recoverable amount. Under this recoverable amount, I made mention that it's either the fair value less cost to sell, which is the net realizable value, or the value in use. So under this, we will have fair value less cost to sell, and we also have the value in use. So as I was explaining the fair value less cost to sell, I said that is what we call the net realizable value. So I can go to the market today and decide to sell the asset. So if I sell it, how much I'm selling it, I just take out the transportation cost, the agent cost, and all those kind of things from it. That's the cost to sell. So the fair value at the market, then I take out the cost to sell. That gives me the net realizable value. Then the question is, what is the value in use? When we talk about value in use simply means that the value I'm going to gain from using the asset to the end of its useful life. When we talk about the fair value less cost to sell, it is me selling it today. But the value in use is me using it to the end of what its useful life, from today to the end of its useful life. The value I'm going to gain is what we call the value in use. So one of this will become the recoverable amount. Which one is the recoverable amount? According to IAS 36, the higher of these two becomes what? The recoverable amount. So for IAS 36, simple, we are comparing the carrying amount with what? The recoverable amount. If the carrying amount is higher than the recoverable amount, then we say the asset has been what? Impaired. If the carrying amount is higher than the recoverable amount, then we say the asset has been impaired. And we are saying that the recoverable amount is as a result of the higher of the fair value less cost to sell and the value in use. Now, what we also have to know is that for the value in use, because you are using the asset from today to the end of its useful life, the amount you are going to gain, the values you are going to gain are what? Future values. They are future values. And therefore, we need to bring that future values to the present. We need to bring that future values to the present so that we can get the amount in today's terms. Because the current amount is in today's terms, right? And the fair value less cost to sell is, we are talking about it today, that if we should go to the market, how much are we going to get? So it means that we need to get the value in use also in today's terms so that we can do a proper comparison. All right. So in that case, then we have to calculate for our carrying amount, right? And how do we calculate for our carrying amount? As I first said, your cost less depreciation. Cost less depreciation. This is so simple. So it's better we take a scenario, then we go through the scenario and understand what we mean by even the recoverable amount. But before then, let me put this down. So we are saying impairment is equal to carrying amount less what? Recoverable amount. And this recoverable amount, we are saying it is the higher of fair value less cost to sell, which is also known as the net realizable value, and the value in use. So basically, this is the idea of impairment. We don't have anything like impairment gain. The word impairment itself is a loss. So we have impairment loss, but we don't have impairment gain. So if, let's say, we should compare carrying amount with our recoverable amount, and our recoverable amount is higher than the carrying amount, then the asset has not been impaired. We leave the asset in our books the same way as it is. We don't touch it again. But if the carrying amount is higher than the recoverable amount, then that's where we have an impairment. So let's go into, we have a scenario, let's look at it and then deal with it. But before we even go to the scenario, here we are talking about a single asset. IAS 36 also talks about a cash generating unit. Cash generating unit. So let me talk about a cash generating unit. So what do we mean by a cash generating unit? So it's a cash generating unit is a unit within an organization which has, let's say, some group of assets that is used to generate what? Income outside the normal income that the organization is generating. Right? It is it is part of what generating the total income of the organization. But if you should separate it alone, it will be able to generate income on its own. And that is what we call a cash generating unit. It's like you having a taxi, or let's say a taxi business. Yes, a taxi business. Then you have about 20 vehicles. If we take one vehicle, each vehicle becomes what? A cash generating unit. Each vehicle becomes what? A cash generating unit. Right. So if this asset gets impaired, if the asset gets impaired, because you know that the cash generating unit will not be there and be working on itself, surely there will be some asset in addition, which is helping it what to generate the cash. So if part of this is impaired, or let's say one cash generating unit is impaired, then the impairment does not affect only one of the assets. It affects the overall cash generating unit, right? It is affecting the overall cash generating unit. So if that cash generating unit has about 3 assets, then we are going to align and make sure the impairment goes with all the 3 assets. But surely there are some circumstances which will let you know that, okay, even though this cash generating unit has been impaired, it is basically this asset which is what? Damaged. So if a particular asset is damaged, then the impairment will first be recognized on the asset which is damaged. The impairment will first be recognized on the damaged what? Asset. So when we talk about cash generating unit, it is a group of assets. So if this group of assets has been impaired, or if this cash generating unit has been impaired, we need to recognize the impairment on the assets one by one. We need to recognize the impairment on the asset. But first, we have to recognize the impairment to what? Any damaged item or a stolen item. So in recognizing an impairment for a cash generating unit, first, you have to recognize the impairment to what? A damaged or stolen asset within that what? Within that cash generating unit. The next thing that you have to, so let's say our impairment is 100,000, but the damaged item is only 50,000. So if the damaged item is only 50,000, we first recognize 50,000 to the damaged item. And in that case, we will be left with what? Another 50,000 of impairment. Where does that go? There are other assets within what? The cash generating unit. So we will have to also associate what? This 50,000, or recognize the other leftover 50,000 on the other assets. So the next thing that IAS 36, or the next asset that IAS 36 is saying we should recognize the impairment to, is intangible assets. Intangible asset. Intangible assets. However, if within this intangible assets, you have something called goodwill, because goodwill is also an intangible asset, right? If you have something called goodwill, then it should be associated to the goodwill first. We should recognize it on the amount of the goodwill first. Then, lastly, talk about prorate. Prorate to other assets. Prorate to what? Other assets. Today, I want us to understand impairment on its own. Then our subsequent videos, we will be talking much about the cash generating unit as to how we are going to recognize any impairment gain from the cash impairment loss from the cash generating unit on the values of what the assets within the cash generating unit. So without much ado, let us go and then have a scenario on impairment. Let's have a scenario on impairment and leave the cash generating unit for our subsequent videos. So let's have this scenario and see how we can best understand IAS 36. Now, illustration 1. Ed owns a vehicle that was involved in an accident at year end. It is barely usable, so its value in use is estimated at 1,000. However, the vehicle is a classic one, and there is a demand for the parts. This results in a fair value less cost to sell of 3,000. The opening carrying amount was 8,000, and the vehicle was estimated to have a life of 8 years from the start of the year. So from the start of the year, we have a carrying amount of what? 8,000. So we need to calculate for our depreciation. Looking at this question, we need to calculate for our what? Depreciation. The useful life which was given to us is 8 years, and the carrying amount at the beginning was 8,000. So we just have to divide our 8,000 by 8 to get what? Depreciation, so that we'll be able to calculate for our carrying amount as at the end of the year. Now, the question has also given us our value in use to be 1,000, and then our fair value less cost to sell to be 3,000. So by calculating our depreciation, we'll be able to get our carrying amount. Then we can compare with the higher of the value in use and the fair value less cost to sell, for which this question is obvious that the net realizable value, which is the value fair value less cost to sell, is 3,000. So we can compare that one with our carrying amount. So let's go to the board and deal with this simple example. Okay, so in analyzing this question, we have our value in use to be 1,000 cedis. And then we have our fair value less cost to sell to be 3,000 Ghana cedis. And then we have our carrying amount at beginning, at the start of year, to be 8,000 Ghana cedis. And then the useful life to be 8 years. So as I said, we need to calculate for our depreciation, isn't it? So depreciation is going to be 8,000 divided by 8 years. And that will give us 1,000 Ghana cedis. So if we subtract from the 8,000, we get our carrying amount at the end of the year to be what? 7,000. So carrying amount year end will be 8,000 minus 1,000 Ghana cedis, which is the depreciation. And that is going to give us Ghana cedi 7,000. By having this 7,000, this is our carrying amount. And you know that for us to calculate for impairment, we need to compare our carrying amount with the recoverable amount. So what is the recoverable amount? Simply, we know that our recoverable amount is what? The fair value less cost to sell, because that is the higher. We need the higher of these two. And that will represent our recoverable amount. And the higher of these two is what? The fair value less cost to sell, which is Ghana cedi 3,000. We can see that the carrying amount is higher than our recoverable amount by how much? 4,000. The difference is 4,000. So impairment loss is 4,000. And this impairment loss will have to be treated in our profit and loss. So normally, if your asset is impaired, it means you are reducing the carrying amount with that impaired amount. So we are going to keep the asset in our books at what? 3,000. So the financial position will have the asset to be 3,000 instead of the 7,000. Instead of what? The 7,000. So impairment loss will go into our P&L. We can add it to our administrative cost or operating cost. Then the recoverable amount, which is now the 3,000, will be in our statement to represent what? The value of the asset. All right. So let's look at the next scenario so that we can end our session for today. Now, if you look at the next scenario, on 31st December 2001, Cons noticed that one of its items of plant and machinery was often left idle. On this date, the asset had a carrying amount of what? 500,000 and a fair value of 325,000. The estimated cost required to dispose of the assets are 25,000. And then if the assets are not sold, so if the assets are not sold, it is estimated that it would generate cash inflow of 200,000 in each of the next 2 years. The discount rate that reflects the risk specific to this asset is 10%. It's 10%. And you are to discuss the accounting treatment of the above in the financial statement for the year ended 31st December 2001. What does that simply mean? So that simply means that they are going to generate 200,000 each year for the next 2 years. And therefore, we have to bring that to the present, right? How do we calculate for the present value? We have been given a 10% discount rate. So we use the 10% to discount the 2,000 for 1 year and discount it for 200,000 for 1 year and for the first year and the second year. Add it and then compare with the fair value less cost to sell. So the question you ask yourself is, in this question, what is the fair value less cost to sell? You were given a fair value of 325,000 and a cost to sell of what? 25,000. So just subtract the cost to sell from the fair value to get what? 300,000. Then we can now find the present values for this 200,000 for first year and for second year. Add both to get our value in use. Value in use simply means that the value I'm gaining if I use the asset to the end of issues for what? Issues for life. So let's go to the board and break down this scenario. Okay. So if you look at the question, the carrying amount that we have is 500,000. And then the fair value is 325,000. Cost to dispose is 25,000. And then the income generation, income to generate per year is 200,000. And our discount rate is 10%. And you know that we are only comparing our current amount with recoverable amount. The current amount has already been given. Here, we were not given number of years and anything to help calculate for depreciation. So the current amount was given to us once, so we just need to take it. Now, in calculating for your recoverable amount, what and what do we need? We need our net realizable value, which is the same as the fair value less cost to sell. And that one is 325,000 minus 25,000. So giving us 300,000. Now our value in use will be the present values for the 200,000 for 2 years. Good. So year 1 and then year 2. Right? Then we'll have the income to be 200,000 each year. Then we are going to have our discounting factor, which we know to be 10%, and then our present value. So what will be 10% for the first year? In calculating for present values, you will have to use 1 over 1 plus r raised to the power n. And the n is the number of what period. So the period, we have period 1 and then period 2. Somebody will also use 1 plus r raised to the power negative n. It will still give you the same results, right? So in this case, we have 1 over 1 plus 10%, which is 0.1 raised to the power 1. And then we also have for the second year 1 over 1 plus 0.1 raised to the power 2. So we multiply each by 200,000. Somebody may also use the annuity formula because it goes with the same what? You have the same amount. But please, for better understanding, let us deal with it one by one. Right. So the first one is giving us what discounting factor. We have 1 divided by 1.1 raised to the power 1. Raised to the power 1. So that gives us 0.9090. So 0.909. Let's use 3 decimal places. So 0.909. Let's go for the second one. What is it giving us? Raised to the power 2 will give us 0.826. 0.826. And we are supposed to multiply it by 200,000. So 0.909 times 200,000 will give us 181,800. And then 0.826 times 200,000 will also give us 165,200. So what will be the total value in use? The total value in use is having the two together. It's having what? The two together. And it gives me 347,000. So our value in use is 347,000. Whilst our net realizable value is what? 300,000. So surely it has to be what? The value in use, which will represent the recoverable amount. So our recoverable amount is equal to 347,000. Let's go and calculate for our impairment then. We have a carrying amount of 500,000, and then we have a recoverable amount of 347,000. Is it 347? Yes, 347,000. So we can simply see that the recoverable amount is more, is less as compared to what the current amount. By how much? So by 153,000. 153,000. So it simply means that our impairment loss is what? 153,000. 153,000. And as we explained earlier, this will go into your P&L, add up to your operating cost, and then this will represent the cost of the asset, the cost of the asset in the financial position, cost of the asset in the financial position. As I always say, if you have any challenge you can put it in the comment section, and we will try as much as possible to reach out to you, whatever it is. God willing, we will be dealing with the cash generating unit in the subsequent videos that we will be doing, right? So today, we just wanted to know what we mean by impairment and how to calculate for impairment and how to even recognize the impairment in our financial statement. So this is where we call it close. Thank you very much for having the time to watch us every day. And I also want to thank you for all the comments on our videos that we've done. But please, I want to plead with you to kindly subscribe, like, and then share our videos if you find it interesting to you. Bye-bye. Here again, let me state again, here again is pros and cons, and you can call me Edward. Bye-bye.